Hello and a very warm welcome. We're diving into a topic that, let's be honest, can feel pretty intimidating, the UK's inheritance tax. This guide is brought to you by the specialists over at My Tax Accountant, and together we're going to break it all down step by step so you walk away with total clarity.
You know that feeling, right? You're just trying to get your affairs in order, maybe dealing with a loved one's estate, and bam, those two words just jump out at you. It can turn an already tough time into a really confusing one. But you know what? It really doesn't have to be like that. So our mission today is super simple. We're going to demystify inheritance tax, or IHT as it's often called. We're going to swap out that feeling of uncertainty with the confidence that comes from actually knowing the facts, understanding the rules, and seeing a clear path forward for you and your family. Okay, here's our game plan. We'll kick off with the absolute basics, then we'll look at your core allowances and see how couples can team up to double their thresholds. After that, we'll dive into the costly traps you need to avoid, and we'll wrap up with some smart planning tips and where to find expert help. Let's get into it.
Right, let's dive in. Before we even touch the numbers, we need to be crystal clear on what we're actually talking about. You hear the word estate. What does that even mean? And what exactly is this tax?
So your estate is pretty much everything you own when you pass away. We're talking about your house, your savings, investments, cars, even things like jewelry. It's the grand total of all your assets. Now, here's the crucial part. The tax is paid from the estate itself, usually by the person handling the will. This means your beneficiaries, the people inheriting from you, don't typically have to find that cash themselves.
Okay, this is the big number that tends to scare people, 40%. But, and this is a really, really big but, it's only charged on the part of your estate that's above a certain tax-free limit. Everything below that limit, it gets passed on completely tax-free. So let's find out what that magic number is.
And this is where the good news really starts. Everyone in the UK gets a tax-free buffer, kind of like a personal shield against IHT. It's actually made up of two main parts.
Here is the first core number you need to lock in for the 2025-26 tax year. Every single person gets a tax-free allowance of £325,000. Think of it as your standard, personal buffer. It's officially known as the Nil-Rate band.
Now, here's a little did you know for you. This $325,000 allowance has actually been frozen since way back in 2009. Because it hasn't got up with inflation, but house prices sure have, more and more ordinary family estates are getting pushed over this limit. It's a classic example of what economists call fiscal drag.
But wait, there's more. On top of that standard allowance, there's a potential extra boost of £175,000. This is a seriously valuable top-up, but, and it's a big but, it does come with some very specific strings attached.
This extra £175,000 is called the Residence Nil-Rate band, and the clue is right there in the name. To get this, you have to pass your main home to your direct descendants. That means your children, and that includes adopted, foster, or stepchildren, or your grandchildren. It doesn't count if you leave your home to a nephew, a niece, or even a really close friend. So if you tick those boxes, your personal tax-free allowance can jump from £325,000 all the way up to £500,000. Not bad, right?
Now this is where it gets really interesting for married couples and civil partners. The rules let you transfer any of your unused tax-free allowance to your partner. And honestly, this can make a massive, massive difference.
So how does this actually work in the real world? Let's imagine a couple, Carol and Simon. Say Carol passes away first. She only uses a little bit of her £325,000 allowance, leaving, let's say, 60% of it unused. Well, that 60% doesn't just disappear. It gets transferred over to Simon. So when Simon later passes away, his own allowance is boosted by that extra 60%. It's a really powerful tool for couples.
And this brings us to the ultimate potential. If the first partner to pass away uses none of their allowances at all, the survivor can inherit their full £325,000 nil-rate band and their full £175,000 residence nil-rate band. You add that to their own allowances, and a couple can potentially pass on up to £1 million, completely tax-free.
Okay, so you get the basics and the allowances. But that's not the whole story. Here's where things can get tricky. Stay with me because the next bit is where we see the most common and the most costly mistakes being made.
This is a big one. A lot of people assume that if they give money or assets away, they're instantly wiped from their estate for tax purposes. Well, unfortunately, it's not quite that simple. HMRC has a rule to stop people from just giving away everything on their deathbed to avoid tax. It's called the 7-year rule.
So, the main takeaway here is this. If you make a big gift and then pass away within 7 years, that gift could still face an inheritance tax bill. As you can see from the table, the tax rate gradually reduces over time. This is called taper relief. It's the full 40% if you pass away within 3 years, but then it drops bit by bit until after 7 full years have passed, the gift becomes completely tax-free.
This is a heartbreaking but really common trap. Sarah, the widow in this example, sold her family home to move somewhere smaller and more manageable. What she didn't realize was that by doing that, she could lose the entire £175,000 residence Nil-Rate ban because she didn't own that main home anymore to pass on. And that single, totally practical decision resulted in an unexpected tax bill of £50,000 for her family.
The good news is these traps are avoidable with some planning. If you downsize, you can make sure your will is written correctly to protect that allowance. For business owners, it's all about structure. Take Priya, a freelance graphic designer in London. She thought her freelance setup would qualify for business relief. It wouldn't have. By restructuring into a limited company, she secured 100% relief on her business assets. And probably the most important tip of all, keep your will up to date. A will from 10 years ago could be a financial disaster just waiting to happen.
Look, knowing the traps is one thing, but having a proactive plan is what really protects your legacy. So let's look at a few simple but really powerful ways to make your allowances work as hard as they possibly can.
Here are 2 brilliant tools for your planning toolkit. First, your annual exemption. You can give away up to £3,000 every single tax year, and it is immediately totally exempt from IHT. No 7-year rule, no fuss. And here's a little pro tip. You can carry forward any unused exemption from the previous year. So if you didn't use it last year, you could actually gift up to £6,000 in one go this year, completely tax-free. Then you have potentially exempt transfers or pets. This is for your bigger gifts. You can gift any amount, and as long as you live for 7 years after you make that gift, it falls completely outside of your estate for tax purposes.
Wow, we've covered a lot of ground today, haven't we? From the basic thresholds all the way to complex traps and smart gifting. The rules can seem complicated, but I hope you can see that with a clear strategy, navigating inheritance tax is absolutely manageable. It's all about taking control and making smart, informed decisions.
So, if you're ready to create that clear plan for your legacy and make sure you're using every allowance you're entitled to, professional advice is absolutely key. The team at My Tax Accountant are ready to help. You can reach them on WhatsApp or by phone at 07854 255 375, or you can drop them an email at info@mytaxaccountant.co.uk. And for more guides just like this one, don't forget to hit subscribe on their YouTube channel.
We'll leave you with this final thought. Planning for inheritance tax, it isn't just about saving money. It's about protecting the future you have worked so hard to build for your loved ones. It's about securing peace of mind. So the real question is, how will you ensure your legacy is protected? Thanks so much for watching.